We're going to get into 5 essential metrics for value investing. These are the ones I like to use. People here watching, if you like or starting to get into fundamental analysis, this might be helpful for you so you can understand a little bit more the company, whether you like financials, fundamentals, technical analysis, or just statistics, or all of them the same. I think it's never hurts to know these things. So
For sure, yeah. I think that like technical analysis, fundamental analysis, options trade, regardless of what strategy you use, they all seem to be like pretty controversial. But I think that and this is kind of what we talked about in last episode's technical analysis breakdown, that like they can still be useful metrics for assessing the market as a whole or summarizing certain aspects of a company's performance without necessarily indicating price trajectory. So there's a lot of different ways that you can use this. People use them for different things. So either way, I think it's helpful to learn about just to get a different perspective on what to look for.
The main goal of value investing is to finding stocks which are priced lower than the real actual value through doing a fundamental analysis. We know that almost the father of fundamental analysis, the father is Benjamin Graham and also Warren Buffett. And some of the ratios which we're going to look into are price to earnings and debt to equity to identify stocks that are actually priced lower than their actual value. But there's a lot of factors that can be priced in, such as like market sentiment and other stuff. And also we got the free cash flow as well, which we're going to look at, Benjamin Graham, which we already mentioned. The first one, and my favorite, price to earnings or PE ratio. This measures a company's current share price relative to its per share earnings. And it's pretty easy to get with the formula, just to divide the share price by its earnings per share, and you get its price to earnings ratio. What does a high ratio indicate? Well, it indicates that a stock might be overvalued as the market is willing to pay more for a company's earnings. And a low ratio, well, that a company might be undervalued, cheaper than its earnings. And here I just put an example that I thought it's pretty interesting. Still, with a big drop, almost a 26% drop this month for Tesla, its PE is still at 43, way more than its competitors, GM or Ford, at an average of 5.3 and 7.6. This is as of today. So you can say that Tesla is overvalued. So investors are paying 43 times more than what Tesla is actually worth. And this is to look at always, I say this, compared to its industry or peers. Yes. And everybody, I just have, if somebody wants to take a screenshot or whatever, I got today's price to earnings ratio by sector.
Nice.
The 11 sectors of the S&P 500.
Nice.
Yeah. So this is the average of each sector as of January of 2024. The second one, the price to book ratio. It actually compares a company's market value to its book value. And what is a book value? Well, it's the value of a company assets minus its liabilities. It's what shareholders will get if the company were to be liquidated. Yes. So a high ratio, similar as the price to earnings, means that a stock is overvalued as the market price is high compared to the company's book value. A low ratio, well, that it's undervalued. Seems like the investors are paying below what the company is actually worth, their assets. Yes. So Julia, I have a question for you in the chat as well. That's my question. Sorry, what do you think that this price to book ratio means, Julia? 1,061 for the S&P 500.
I don't have a sense of scale for something like this, but I'm going to assume that means the market's overvalued.
Not really. That's you have to take that with a grain of salt. Overvalued, because what do you compare the S&P 500 to? No.
There's not really a lot of. I mean, like there's foreign market indices, but we're in kind of a unique situation with our own economy. Yeah. So I don't have a good frame of reference for something like this actually.
Yeah, these are the big leagues. So what does this tell us? Well, that the book value of the S&P 500 at $1,061 means that the average net assets minus liabilities of all the holdings of the S&P 500 of the companies in the index is 1,061 per share. So this means like if everything were to be liquidated to the assets, the real value, like you could say in quotations, it's actually per share of the S&P 500. It's not almost 5,000. It's 1,061.
Wow.
That's when a lot of debt comes in. And why are the prices of the S&P 500 like that? Well, because companies are really big, and how do they grow? Well, with debt. But Yeah, that's something cool to see. I just brought it for the S&P 500. There's nothing much to compare it to. So
Interesting.
investors, just as a price to earnings, compare it to the industry, to the sector, or to the peers, especially
Mhm.
peers.
Yeah.
The third one, debt to equity ratio, also one of the most important ones to see how much debt does a company have. So this shows the proportion of a company's financing that comes from creditors and investors. Yes, so we know that the debt from investors or yeah, from investors who are going public, it's actually better than just debt overall from a bank.
Hmm.
The high ratio means that a company may be risky as it uses more debt to finance its operations. Most of them do that to be able to grow. And a low ratio suggests that a conservative approach with more financing from shareholders.
Hmm.
You're going to watch high ratios in growth stocks companies,
Hmm.
companies that do not pay dividends, versus low ratio companies, debt to equity, grow like value companies, for example, IBM, these companies, Apple as well, that tend to pay dividends. So
Interesting.
yeah, and I just put this as a like a benchmark. A good debt to equity ratio, it's around 1 to 1.5 debt to equity.
Hmm.
But as always, compare it to its industry, peers, and also sector.
For sure. Yeah, that makes sense.
And the free cash flow, the fifth one, this literally means how much money the company is receiving after capital expenditures, which are overhead expenses, rent, salaries, everything you can imagine except the taxes.
Mhm.
So cash flow, that's what it means. You want to see for a company that has higher free cash flows. Yes,
Mhm.
and you can see the growth year over year, quarter over quarter. This is different as the past ones. You don't compare them to the industry
Mhm.
or to your peers normally because it might be pretty different. You compare it to the same company, whether they were, if you do a vertical analysis,
Mhm.
their previous quarters, if it's been growing or not. Yes,
Interesting.
and I have today's free cash flow for Apple.
Mhm.
It will be reporting today, but just to watch, it's amazing. Apple for the first 9 months of 2023, because we don't get today's numbers still, so it's up for the previous earnings quarter. They generated 110.5 billion for operating cash flow. Operating cash flow is just the total amount of money they just generated, yeah, by their revenue. And the free cash flow is the first 5 months as well of 2023. They takes out capital expenditures, so salaries that we mentioned, rents, everything that you can imagine except taxes. 99.5 billion. So Apple is a behemoth,
It really is.
earning more because we're gonna get today's number, and I don't expect it to be negative. So more than $100 billion every year just on free cash flow. That's
Holy
why they're able to pay their dividends. That's why they're able to grow so much on research and development, their campus, and that's why they have so much money. They have around like $250 billion in
Mhm.
cash. So Apple will be reporting earnings today, and it's gonna be interesting to see what do they report. So
Very
um,
yeah.
the lastly, so was not the free cash flow, it's a PE growth
Mhm.
ratio. This is the adjusted price to earnings ratio, but with the expected earnings growth. We've already talked about it. We already know that investors and analysts, banks, always
Mhm.
have their expected earnings for each company for the upcoming quarters and years.
Mhm.
And a high ratio above one normally suggests a stock is overvalued relative to its growth prospects, and a low ratio below one implies that a stock may be undervalued given its earnings growth projections. Yeah,
Mhm.
so I took for tech as a comparison. You can see all in red because they're all above one.
Mhm.
That signals that they're actually overvalued.
Yeah.
Normally, that their current valuation it's higher than what do we expect for the future earnings growth. Yeah,
I'm not
so
terribly surprised by that, given how speculatively the tech sector, a lot of big companies across the tech sector are often traded.
yes, so these are one of my favorites. My top five
Nice.
favorite metrics to use as it started. I think they're very simple to adjust. You don't get too much confused, but yeah, this is Julia for
Nice.
my overall metrics for fundamental analysis for people who are just starting to invest.
Awesome. Thanks so much for putting that together. That was actually really helpful because I hear people talking about these metrics and genuinely have no idea what they mean. Never bothered to look into them. So that was a really helpful summary.